Greetings, hi, this is Brad Keller with Bradstreet Proper LLC. We are a property management company based out of Columbus, Georgia. Today we're going to talk about balancing repairs versus returns, okay? Repairs versus returns. So as a new investor, you want to buy a property and you want to see a return on your investment. So if you're a good first-time investor, you have calculated all your numbers and your numbers look good and they tell you that you're going to get a 10 or 15% cash on cash return, which I've talked about in previous videos. And so you're excited. Okay, I'm going to get a cash on cash return, and then we start to go, and suddenly the roof needs to be replaced or a water heater needs to be replaced. And you're now looking at your returns disappear, okay? You had, let's just say you're earning a cash return of $200 per month, okay? And now you have a water heater that needs to be replaced. That's $1,000, okay? So 5 months of profits just disappeared. And so you're thinking, well, was this a good idea? All right. Well, the first thing I would say is the first 6 months of a property's ownership are what I call the stabilization period, okay? So the first 6 months, just be prepared. Repairs will happen. So I always add a couple $1,000s of repair budget in the first 6 months because I know it's going to happen. So no longer am I surprised a tenant moves in, there's going to be repairs because they're going to find things that you didn't. Now, the idea would be that we would go over these properties with a fine-tooth comb before someone moves in so that we have less of a stabilization period, but it still happens. And I've tried to dial this process in to where I have zero stabilization period, but even my properties, we still find things after, in that first 6 months. And so things are going to break. And so you're going to find problems, okay? Now, so here's where the tension comes in between returns and repairs, okay? And so if you don't do repairs, you're going to maximize your returns. But it's very short-sighted because you want that asset to last you for decades, okay? You want to get at least a 30-year run out of that house. And the only way that's going to happen is if you do your repairs. So the idea is we take some hits like that. And that's part of, depreciation expense and being able to expense those repairs on your taxes, because the government knows that the houses depreciate. They fall apart, and we have to be able to repair those, and so they give us tax breaks accordingly. So you're going to take that property, and you've got to keep up with it, okay? If you let it fall into disrepair, you're going to maximize cash flows, okay? But at the end, you're not going to be able to sell that property without significant investment, okay? I've seen people who have properties and they let them sit, and they get these tenants that just deal with problems and they don't care, and they're basically slumlords. And then they're dealing with a situation where they've got to invest, $30,000 in a $50,000 house. And so it makes more sense to maintain that property and to keep it up throughout the process, little by little. It's little tiny investments as you go to ensure that that property is going to perform for you over the long run. So that's the challenge as investors. We have to look at, balancing, maximizing cash flow and repairs. And so, that's the strategy. And so, as an investor, we have to walk that fine line. But if you build that into your model, in your financial models in the beginning, it won't be so painful. You'll come up with a realistic cash flow that will, account for all those repairs. And so we have to walk that line. But what I would say is don't try to maximize cash flows to the extent that you neglect your asset. Thanks so much.